Good morning, everyone, and welcome. I call this meeting of the NCUA Board to order. I want to note that for the record that due to the COVID-19 pandemic, today's meeting is open to the public through a live webcast only. The public may access the meeting by visiting the agency's homepage at www.ncua.gov and clicking on the provided webcast link. Additionally, presenters in today's meeting are participating remotely. So if we experience any technical difficulties, I ask for your patience. Before we get to today's first item on the agenda, I would like to highlight the upcoming Monday deadline for submitting the annual Credit Union Diversity Self-Assessment. Greater diversity, equity, inclusion, and belonging are essential to the success of the credit union industry. And the annual Credit Union Diversity Self-Assessment is a critical first step in moving from intention to action in a credit union's DEI journey. The submission of self-assessments are neither seen nor made part of the regulatory or examination processes. Results from these voluntary assessments are viewed in the aggregate, not individually, and have no bearing on a credit union's CAMELS rating or examination findings. For any credit union watching today's proceedings, if you have not done so already, we encourage your credit union to complete and submit your credit union diversity self-assessment to the Office of Minority and Women Inclusion by Monday, January 31st. You can find the assessment at cudiversity.ncua.gov. Again, that's cudiversity, that's one word, .ncua.gov. And you can ask questions of OMWE about the diversity self-assessment by emailing omwemail@ncua.gov. The first item on our agenda today is a board briefing about Final Rule, Part 747, Statutory Inflation of Civil Monetary Penalties. Staff presenting, Gira Bose, Senior Staff Attorney, Office of General Counsel. Good morning, Gira. You may begin whenever you are ready.
Thank you, Chairman. This is Gira Bose with the Office of General Counsel. Good morning, Chairman Harper, Vice Chairman Hopman, and Board Member Hood. Pursuant to the Federal Civil Penalties Inflation Adjustment Act Improvements Act of 2015, all federal agencies that impose civil monetary penalties, or CMPs, are required to make annual adjustments to the maximum levels of their CMPs to account for inflation. The adjustment calculation itself is based on the percentage difference between the Consumer Price Index for urban consumers over the preceding 2 years. The Office of Management and Budget is required to issue guidance to help agencies fulfill this requirement, including providing the inflation multiplier that agencies must use in their calculations. Agencies do not have the discretion not to undertake this rulemaking. It's a mandatory requirement. The only exception would be if an agency has already made an adjustment to a CMP in the preceding 12 months in an amount greater than required by this statute. In that case, the particular CMP would not have to be adjusted. The NCUA did not make any such adjustments to any of its CMPs, so that exception does not apply, and the agency is bound to comply with this annual requirement. The timeframes for finalizing this rule are narrow, with the OMB guidance being issued only 1 month before the rule must be published in the Federal Register. As a result, the statute permits agencies to bypass the usual Administrative Procedure Act process and move straight to a final rule. The board approved this rule by notation vote on December 29th, and it was published in the Federal Register on January 5th. That concludes my briefing. I'd be happy to answer any questions. Back to you, Chairman.
Thank you so much, Gira, for your presentation today. It is important that the agency provide transparency to the public about the actions the NCUA board has taken. Gira, your briefing today has provided us with a clear understanding of the background on the NCUA's board's recent vote to adjust the civil monetary penalties in our rules. I appreciate the work of you and so many others in making these inflationary adjustments in a timely manner. I have no further comments. I now recognize Vice Chairman Hopman.
Thank you, Mr. Chairman. I don't have any prepared remarks. Just want to ask a question, which is, as interesting as this process is, what sort of things trigger a CMP? If you're a credit union out there, I'm sure it's what you're wondering. what would get them assessed a civil monetary penalty?
Thank you for the question, Vice Chairman. There are a number of statutory provisions that can trigger a CMP, and these are listed in the regulation that was amended as a result of this rulemaking, and that can be found at 12 CFR 747.1001. Many of the statutory provisions are comparable to the penalties that can be issued by the federal banking agencies and the Consumer Financial Protection Bureau. Examples are failure to file a call report or the late filing of a report. The penalty caps will vary depending on whether the violation was inadvertent or intentional, with higher penalties for intentionally false or misleading filings. Another example would be penalties can be assessed for failure to submit certified statements of insured shares and charges due to the share insurance fund, again with higher penalties for false or misleading statements. Penalties could also be assessed for non-compliance with flood insurance requirements, for example. But the full list is set forth clearly in the regulation. Back to you, Vice Chairman.
Okay, and just reiterate, what is the the agency is not required to charge the maximum, though, right?
That's correct. The statute only requires that agencies keep their CMP maximums adjusted annually. It does not require that agencies impose the maximums. In fact, the Federal Credit Union Act requires the agency to consider mitigating factors when determining the amount of any penalty, such as the size of the credit union, any history of previous violations, and the gravity of the violation. Just for your information, in 2020 and 2021, due to the financial stress caused by the pandemic, the agency did not issue any CMPs, and the agency rescinded those that were in process during the third quarter of 2019. And to give you an idea of the dollar amounts assessed, in the first 2 quarters of 2019, the agency imposed 13 penalties with an average penalty amount of $385. All of those assessments can be viewed in a searchable format on the NCUA website. Back to you, Chairman.
Thank you for that. Back to Chairman Harper. I'm done.
Thank you so much. Board Member Hood, you are recognized.
I want to thank you, Gira, for that presentation. And I have no questions or comments. I just want to thank you all for your hard work on this. And I'm delighted that we as a board could already vote on this via notation. But today's briefing was just to let the industry know that we did act on this. So thank you. No further questions or comments, Mr. Chairman.
Absolutely. Thank you so much, Board Member Hood. That concludes our discussion of Final Rule, Part 747, Statutory Inflation Adjustments of Civil Monetary Penalties. The second item on our agenda today is Proposed Rule, Part 701, Succession Planning. Staff presenting is Ariel Pereira, Senior Staff Attorney, Office of General Counsel. Ariel, you may start at any time.
Thank you, and good morning, Chairman Harper, Vice Chairman Huffman, and Board Member Hood. My name is Ariel Pereira, and I am a Senior Attorney in the Office of General Counsel. I'm here this morning to present the proposed rule on succession planning. The Office of General Counsel drafted the proposed rule based on direction provided by the Office of the Executive Director. Succession planning is recognized as vital to the success of any institution, including credit unions. Through this proposed rule, the board will require that federal credit union boards of directors establish and adhere to a succession planning process. The proposed regulatory amendments would apply solely to federal credit unions. Federally insured state-chartered credit unions must comply with any state-specific requirements pertaining to succession planning. However, the preamble to the rule encourages FSCU boards, to the extent compatible with state law, to undertake succession planning efforts. In addition, the proposed rule would not amend the board's corporate credit union regulations. As explained in the preamble, these regulations already adequately address succession planning. Several factors have contributed to increase the relevance of succession planning for credit union boards. First, there has been a decline in the number of credit unions, which is consistent with the long-running trend in consolidation across all depository institutions. One of the reasons for the consolidation is the lack of succession planning. An NCUA analysis found that poor management succession planning was either a primary or secondary reason for almost a third of credit union consolidations. Call report data suggests that mergers may be more prevalent among smaller credit unions. For example, the number of federally insured credit unions with less than $10 million in assets declined to 1,068 in the third quarter of 2021 from 1,199 in the third quarter of 2020, a decline of 131 credit unions. The available data does not differentiate between those smaller credit unions that consolidated or were liquidated versus those that expanded into a larger asset category. However, the decrease in the total number of smaller credit unions, combined with the ongoing industry trend of consolidation, suggests that consolidations are a factor in that decrease. Another reason for a heightened focus on succession planning are the ongoing retirements of the so-called baby boomer generation. According to some sources, approximately 10% of credit union chief executive officers were expected to retire between 2019 and 2021. The proposed rule would amend Section 701.4 of the board's regulations, which sets forth the general duties and responsibilities of federal credit union directors. The proposal would add a new paragraph E to that section, which would require that directors must establish and adhere to a process for succession planning for key positions. The rule would define what those key positions are. In specifying the officials covered by the succession plan, the proposal relies on the language of Section 111 of the Federal Credit Union Act, which provides that, quote, the management of a federal credit union shall be by a board of directors, a supervisory committee, and, where the bylaws so provide, a credit committee, close quote. The Federal Credit Union bylaws that are codified in Appendix A of the regulations in Part 701 expand the list of senior credit union executives to include the members of an executive committee and management officials. These officials would also be required to be covered in the succession plan. The board of directors or an appropriate committee of the board would be required to review and approve a written succession plan regarding the specified executives and officials. The succession plan must, at a minimum, identify the credit union's key positions, necessary competencies and skills for those positions, and strategies to identify alternatives to fill vacancies. The board of directors would be required to review the succession plan in accordance with the schedule established by its board, but no less than annually. In addition, the proposed rule would amend Section 701.4(b)(3), which contains certain education requirements for federal credit union directors. The amendment would require that directors have a working familiarity with the succession plan. The design of the proposed rule is intended to minimize the burden on federal credit unions. The proposed regulatory amendments provide credit unions with broad discretion in how to implement the new requirements. For example, while the proposed rule would require succession plans to include certain mandatory elements, the rule does not specify how the topic should be addressed, nor does it otherwise prescribe any of the contents of the succession plan. The expectation is for credit unions to develop a plan and provide training that is consistent with the size and complexity of the credit union. Therefore, smaller credit unions are more likely to have a simple succession plan that only addresses a few key leadership positions. The proposed rule envisions that the examination program would confirm the existence of a succession plan and training. The proposed rule would be published for a 60-day public comment period, and all comments would be considered in the development of the final rule. This concludes my prepared remarks. I would be happy to answer any questions you might have. Back to you, Chairman Harper.
Thank you so much, Ariel, and Board Member Hood, welcome back to the video portion of the meeting. Ariel, thank you very much for your thorough presentation of this notice of proposed rulemaking on succession planning at federal credit unions. I appreciate the hard work made by you and your colleagues in the Office of General Counsel that went into crafting today's proposal. Before I begin to explain the reasons why this proposal is essential, especially to help maintain the viability of small credit unions and a diverse system with many small credit unions, I would like to thank Vice Chairman Hoffman for working with me to improve the proposed rulemaking. His suggestions go to the heart of the costs and benefits of this rulemaking to credit unions, as well as to regulatory flexibility. Through this proposed rule, the NCUA board would require the boards of federal credit unions to establish and adhere to processes for succession planning. The succession plans would help to ensure that the credit union has strategies in place to fill key positions, such as officers of the board and key management officials, to provide continuity of operations. Although the proposed rule would apply only to federal credit unions, the purpose of this rulemaking is to encourage and strengthen succession planning for all credit unions. Significantly, the proposed rule would provide federal credit unions with broad discretion in implementing the proposed regulatory requirements by minimizing any potential burden. Succession planning is the process through which an organization identifies, develops, and retains key personnel to ensure its viability and continued effective performance. Succession planning also allows an organization to prepare for the unexpected, therefore minimizing service disruptions during management transitions. Moreover, succession planning is recognized as vital to the long-term success of any institution, including credit unions. A board's failure to plan for the transition of its management could potentially come at a high cost, including potentially for the unanticipated merger of the credit union upon departure of key personnel. Put another way, succession planning helps to safeguard the credit union's members' choice of financial institution. When previously serving on the board of a small nonprofit, I once saw firsthand the benefits of succession planning. At the time, that organization had annual revenue of approximately $650,000, and it underpaid its executive director. The board's foresight in developing a succession plan, including what would happen if the leader departed suddenly, and increasing the salary structure, allowed for the organization to withstand the uncertainties created during a subsequent management transition. At about the same time, another nonprofit in the same area of work and in the same vicinity and with more than twice the revenue folded when its chief executive abruptly left. The organization did not have succession planning in place. Several factors have contributed to increasing the relevance of succession planning for credit union boards. First, there is a long-standing steady decline in the number of credit unions. This trend has remained relatively constant across all economic cycles for more than 3 decades. In fact, we are losing credit unions much faster than we can replace them with new charters, and we must find a way to keep small credit unions viable over the long term. So it is time to try something new. The consolidation trend is especially apparent in smaller credit unions, as Ariel pointed out. During the third quarter of 2021, the number of federally insured credit unions increased in every asset category tracked by the NCUA, except for those with less than $50 million in assets. Another NCUA analysis found that poor management succession planning was either a primary or secondary reason for almost 1 in 3 credit union consolidations. And it is very important to note that the Federal Credit Union Act contains provisions that disfavor consolidation, implying a presumption that the public is better served with a greater number of credit unions. Another reason for the heightened focus on succession planning is the ongoing retirements of the so-called baby boom generation. The COVID-19 pandemic has accelerated the path of retirements among this generational cohort. And according to some sources, even before the pandemic started, about 10% of credit union chief executive officers were expected to retire between 2019 and 2021. Succession planning is critical to the continued operation of those credit unions for the board members and executives who are part of this retirement wave. Since joining the NCUA board, I've been a strong proponent for succession planning. Over the past 3 years, I have also been encouraged by some in the credit union movement to pursue this rulemaking. One CEO told me, succession planning has a ton of merit, and we look forward to weighing in on the subject. Kudos for addressing it. From what I have seen, that's one of the biggest reasons that mergers take place at small asset credit unions. Another industry leader encouraged me to wake up the industry up to planning as long as there is flexibility. The longer I do this, the more I understand how we need to have reasonable regulation that is risk-based. We want to spend our time serving the members first and giving them value. So what you are concerned about is no question a high risk for small credit unions. The same individual stressed to me that after having consulted with a lot of small credit unions over the years, they are often looking for new candidates, but what you find is that many of them have CEOs that have been there for decades. These CEOs hung around and never made a very current day salary. So when the boards go out to look for a current day CEO, they feel priced out of the market. Finally, when growing up, I spent several years at Benjamin Franklin Elementary in my hometown. In doing so, I became quite familiar with Franklin's many witty financial insights, like a penny saved is a penny earned, and I took to heart his lessons about compound interest. Money makes money, and the money that makes money makes money. We often hear these wise words echoed in credit union marketing materials. But our famous founding father had another quote on management that directly applies to this rulemaking. If you fail to plan, you plan to fail. At its core, this rulemaking is about federal credit unions of all sizes, especially smaller credit unions that do not already have succession plans, planning for their futures so they can continue to serve their members for generations to come as independent entities. Small credit unions are at the heart of the credit union movement, and we need to find a better way to preserve them instead of consolidating them. For all these reasons, this succession planning proposal is essential. And notably, instead of applying a rigid standard and methodology for such strategic planning, this flexible rule allows credit unions to develop succession plans that best meet their needs. Before concluding, I do have a few questions for you, Ariel. First, would you please explain in greater detail how this proposal provides credit unions with leeway and flexibility to develop their succession plans?
Yes, thank you, Chairman Harper. The proposed rule design definitely takes the burden on credit unions into account, and there was an attempt to minimize that burden and to provide the credit unions with the broad flexibility and discretion in how to implement the new requirements. For example, the proposed rule would require succession plans to include certain mandatory aspects. As discussed, succession plans would have to list the number of key officials and the skills and competencies necessary for those positions. However, it would not specify how those topics should be addressed. It also does not prescribe any of the other content of the succession plan. The proposal would also require that directors have a working familiarity with the succession plan, but does not mandate the content of the training to meet this requirement. Again, the expectation is that a credit union will develop a plan and provide training that is consistent with its size and complexity. This concludes my response. Back to you, Chairman.
Ariel, thank you for those insights. I want to talk about a credit union that may already have a succession plan in place. Would this proposal require the credit union to change anything in its plans if, for example, the credit union's board has already adopted a strong succession plan that is that the credit union's board and the credit union's management are following?
Thank you. Credit unions would not be required to duplicate or discard current planning efforts. Credit unions could keep existing succession plans in place so long as their plans cover the officials specified in the proposed rule and the other required elements. The rule also encourages credit unions to use any existing information they may have developed for other purposes in preparing their succession plans. This concludes my reply. Back to you, Chairman Harper.
Thank you, Ariel. So what I hear you saying is that this proposal would create a floor and not a ceiling over the type of succession plans that a credit union board may adopt, and it provides maximal flexibility. Is that correct?
Yes, it is, sir. That's correct. Back to you.
Thank you. Finally, Ariel, I want to focus on the initial costs of implementing this rule. What free and low-cost resources might be available to a credit union's board to draft and approve a succession plan?
Thank you for your question. There are several resources that are available to assist credit unions in developing the required succession plans. The NCUA, for example, has posted online training on succession planning through its learning management system. That link is provided in the preamble to the proposed rule. In addition, credit union and trade associations may also provide training and have guidance available to assist credit unions. Further, credit unions with low income designation may be able to apply for technical assistance grants to support succession planning or offset the cost through the Community Development Revolving Loan Fund. Credit unions are encouraged to make use of these and other available resources in complying with the proposed rule. Back to you, Chairman Harper.
Ariel, thank you again for your hard work. To conclude, credit unions should be thinking ahead of what is to come before it comes up on them. At the same time, through this rulemaking, the agency recognizes the need for flexibility and to not take a one-size-fits-all approach. Finally, as Ariel noted, this rulemaking will be open for a 60-day comment period, and I really do encourage all interested stakeholders to weigh in on this important matter. That concludes my remarks. I now recognize Vice Chairman Hauptman.
Thank you, Mr. Chairman. Thank you, Ariel, for that presentation. I'd like to first state that this issue, succession planning, is one where I agree it is a real problem for some credit unions. Our job is to figure out if further NCUA involvement is beneficial, and if so, how do we ensure there's no burden on credit unions that have done sufficient succession planning? The Federal Credit Union Act states that the board of directors must oversee the credit union's operations to ensure the credit union operates in a safe and sound manner. The primary goal of succession planning is protection of the member. It all comes back to the member. Over 30% of murders in small credit unions are primarily or secondarily attributable to lack of succession planning. This is significant and troubling. The cooperative business model, by definition, gives greater choice to the individual member regarding the direction of their credit union. When a member has no option but to vote for a merger because there's no succession plan for the CEO, they've lost that choice, and ultimately they've lost their native credit union. That's not to say a merger isn't the right choice for some credit unions, but the choice to merge should be deliberate and planned. You've heard me say before that regulators don't realize how hard their words land on those they regulate. I've seen firsthand how a casual comment by an examiner can bring a project to a halt at a credit union, through no fault of the examiner, except the examiner didn't realize the impact. When I look at this proposed rule, or any rule for that matter, I worry about unnecessary burdens placed on already stressed credit unions. We should not create work for the majority of credit unions in order to address a challenge in a handful of others. We're asking for stakeholder input on the burden of the rule and welcome suggestions for less burdensome alternatives. Ultimately, a succession plan is one of management's most important responsibilities. For millions of members, succession planning means greater choice over their financial lives. It all comes back to the member. That concludes my remarks. I do have a couple questions. One is, does the rule give NCUA the ability to dictate the appropriateness or acceptability of a credit union succession plan?
Thank you, Mr. Vice Chairman. The proposed rule, while it does specify certain elements that need to be included in the plan, does not micromanage or dictate the contents of succession plans. The rule envisions that the examination program would confirm the existence of a succession plan and training. The examination program would defer to a credit union self-assessment of its succession planning needs and the information contained in the plan, so long as the plan addresses those elements that are required by the rule. That concludes my answer. Back to you, Mr. Vice Chairman.
Thank you. And when you refer to the plan, will a credit union be able to use existing documentation, such as board minutes or disaster recovery plans, to comply?
Thank you, Mr. Vice Chairman. Yes, many credit unions should already have the necessary information to complete the succession plan as a result of other planning and documentation efforts. Rather than undertaking new analysis specifically for the succession plan, credit unions are encouraged to use already existing information in preparing their plans. For example, under NCUA guidelines, all federally insured credit unions are encouraged to develop a program to prepare for a catastrophic act. These plans, I should say, likely address several elements that are also relevant to succession planning, and those elements should be incorporated in succession plans or can be incorporated. This concludes my response. Back to you, sir.
Gotcha. So I'll just say that for example, a disaster recovery plan, which, like you said, should include the issue of succession planning, credit unions who have that already, they shouldn't have to open Microsoft Word or create something called successionplan.doc if this is already there. The only last question I was going to do, Chairman Harper already asked, which was about resources available to comply. And for those interested, I would refer you back to Ariel's excellent answer to the chairman's question about free or low-cost resources to comply with this rule. That concludes my remarks. Back to Chairman Harper.
Thank you so much, Vice Chairman Hopman. And again, I really do appreciate your insights and additions to this rulemaking. Those questions are really going to be a benefit to us as we evaluate this proposal going forward. Board Member Hood, you are now recognized.
Thank you, Mr. Chairman, and thank you, Ariel, for your presentation this morning on succession planning. I must say that I will not be supporting today's rule because as a safety and soundness regulator, I believe that regulation needs to be effective and not excessive. That to me means regulation needs to strike the right balance between the safety and soundness of the credit unions we oversee and also examining the compliance costs and burdens credit unions face each and every day. I look at the issue before us today as a corporate governance issue. I look at it as an issue where we don't really need to have a rule or proposed rulemaking in place to do what we can perhaps encourage credit unions to do by using some of the resources that Ariel has already mentioned today. If succession planning is, in fact, an issue for credit unions, let's have more succession planning webinars, issue guidance letters to credit unions, and make it a more prominent tool in our regulatory toolbox. We actually already currently include succession planning in our regulatory toolbox by including it in the management component of the CAMELS score. I heard from a smaller credit union that was actually downgraded in their management component of the CAMELS score for an inadequate succession plan. So maybe we should look at sharpening this tool that is already in our toolbox. Further, I really do worry that today's proposed rule would be counterproductive and that it will produce the exact opposite result of its intended effect. I don't think anyone would question the commitment that I have to our small credit unions, our LIQs, our MDIs, our CDFIs, and to the overall system. I want them to succeed. Yes, I recognize that there are mergers that are taking place each and every day, and I want us to make sure that they get the resources. But is using a blunt instrument or a proposed instrument of a rulemaking, is that the right way to do it? The smallest credit unions are struggling to stay open, and today's rule, I think, could actually accelerate mergers in my view. I do have one question for you just for the moment, Ariel, and then we'll continue. Can you please confirm that the NCUA estimate that this rule will take credit unions 30 minutes or so to create a succession plan for the first year under the guidelines laid forth by the Paperwork Reduction Act?
Yes, sir. Thank you, Mr. Hood. That is an estimate that is contained or will be contained in a Federal Register notice that will be published for public comment, as you noted, under the Paperwork Reduction Act. This is an estimate, and it was based on the burden imposed by other similar information collections required by the NCUA. As required by the Act, the estimates will be published for public comment, and the NCUA will have the ability to adjust the burden based on that input. Back to you, Mr. Hood.
Great, thank you. But I must just add, Ariel, I think that a succession plan that's only going to take 30 minutes to complete is either a check-the-box exercise and endeavor or woefully underestimated in terms of what we're looking at as a regulatory burden. And again, I see the problem before us today regarding succession planning, like other problems facing the credit union industry, as the need to have more effective governance by the members of credit unions. It's up to the member owners to address this issue and to know their rights, duties, and obligations in a transparent and clear manner. It's our responsibility to supervise these credit unions to keep the system safe and sound while also protecting our National Credit Union Share Insurance Fund. I don't think it's our responsibility to micromanage. Another question, Ariel, is what are our peer regulators doing regarding succession planning? Do they have also a guidance or rulemaking in place?
Thank you, Board Member Hood. The Federal Reserve Board has addressed succession planning in guidance, in its supervisory guidance to be specific, on board directors' effectiveness, and that was issued on February 26, 2021. The Office of the Comptroller of the Currency has addressed what it terms talent management processes in guidelines that are codified in Appendix D to its safety and soundness standards that are found at 12 CFR Part 30. Back to you, sir.
Great, thank you for that. And then I also am aware that the FDIC has also done webinars and training sessions on this matter. yes, I recognize that just as we're losing credit unions and not losing them through poor performance or poor capital liquidity, but because of some of the mergers, that is happening in all of the financial services industry. So if our peer regulators have, again, addressed it through guidance, through letters and webinars, I think that bodes well for something that we should follow as well. Another area that I'd like to talk about is, Ariel, do you have any knowledge as to what we at NCUA are doing by way of succession planning? I know we heard earlier today that there are a number of the percentages of CEOs who are about to retire with the baby boomer generation and all that. Well, that's also mirrors, I believe, what we see here at the agency. Well, I don't really have the exact data points, but I recognize that we do have a number of folks here who are eligible to retire. What is NCUA doing by way of succession planning, to your knowledge?
Thank you for your question. As of today, the NCUA does not have a succession plan process for leadership. However, the Office of Human Resources has advised that it is in the process of developing a strategic workforce planning program, and that succession planning will be part of that larger plan. Back to you, sir.
Great. Thank you for that, Ariel. So again, I just would like to note that what we're asking the industry to do, we would be remiss if we did not address some of those same types of issues as well. So I'm delighted to know that that is something that's in the works. But that being said, I still do not think that a rulemaking is required at this time. And for all the reasons I've enunciated, and most importantly, my regulatory mission has always been, whether I was here a decade ago or now, regulation needed to be effective but not excessive. And it's my opinion that this would be teetering on the board or brink of being a bit excessive in the sense that we have guidance and other things we can do to address this need. But thank you all for your hard work. Thank you. I do recognize that this is an issue. I just don't know if we're addressing this issue with the best tools that we have available. Thank you. I have no comments at this time now. Mr. Chairman, I cede back my time.
Board Member Hood, thank you for very thoughtful questions. I really do appreciate them. With that, let's move to consideration. Vice Chairman Hoffman, is there a motion?
Yes, sir. I move that the board approve proposed rule, Part 701 of NCUA's Rules and Regulations, for a 60-day comment period as attached to the board action memorandum.
Is there a second to the motion? Hearing none, I will second the motion. All those in favor say aye. Aye.
Aye.
All those opposed say nay.
Nay.
The ayes have it, and let the record show that the motion passed 2-1. The third item on our agenda today is a board briefing on the NCUA's 2022 supervisory priorities. Staff presenting are Kelly Lay, Director, Office of Examination and Insurance, Nagi Khalid, Policy Officer, Office of Examination and Insurance, and Matt Valoris, Director, Office of Consumer Financial Protection. Staff available for question includes Ernestine Ward, Consumer Compliance Policy and Outreach Program Officer, Office of Consumer Financial Protection. And to both Nadia and Ernestine, welcome to your first board meeting. You all may begin when you are ready.
Good morning, Chairman Harper, Vice Chairman Hoffman, and Board Member Hood. Thank you for the opportunity to present the NCUA's supervisory priorities for 2022. Next slide, please. On this slide and the next two slides, you will see the various subject areas from the supervisory priorities letter to credit unions. The supervisory priority areas and other reminders will be discussed in the order in which they appear in the letter. Next slide, please. Policy Officer Nagi Khalid and I will cover most of these areas, but Office of Consumer Financial Protection Director Matt Valoris will discuss the supervisory priorities associated with consumer financial protection. Next slide, please. We'll also briefly cover other exam program updates discussed in the supervisory priorities letter as shown on this slide. It is important to note that NCUA examiners will be including scope items for these priorities in examinations beginning on or after February 28, 2022. Credit union examinations that are in process or started before February 28 will not need to include the new 2022 priorities. Next slide, please. At this time, I'll turn it over to Nagi.
Thank you, Kelly, and good morning, Chairman Harper, Vice Chairman Hoffman, and Board Member Hood. As Kelly noted, I'll go over some of the 2022 supervisory priorities with you today. Credit risk management remains a regulatory focus for the NCUA. In 2022, the NCUA will focus on how the COVID-19 pandemic and the resulting government responses and programs impacted lending practices and credit quality, and how credit unions revised their internal practices, policies, and procedures to respond. NCUA examiners will review credit risk management and controls over new or material lending programs, including policies and procedures implemented in response to the COVID-19 pandemic. This will include reviews of loan policies, underwriting, portfolio management procedures, governance over material loan concentrations, tools and models used to evaluate and report on credit risk, and forbearance, loan accommodations, or modifications made due to COVID-19. Additionally, NCUA examiners will review changes to credit union programs that were implemented as a result of the COVID-19 temporary regulatory relief that was extended through December 31st, 2022. This relief included increasing single originator loan participation limit to 200% of net worth and allowing federal credit unions to purchase eligible obligations from any source, provided the federal credit union is empowered to grant the loan. Next slide, please. The review of credit union information security practices continues to be a priority for the agency. Cybersecurity risk remains a significant threat to the financial system. The likelihood of these threats adversely affecting credit unions and their members persists. Ransomware, third-party, and supply chain risks and business email compromises are concerning. The NCUA is updating information security examination procedures that are tailored to institutions of varying sizes and complexity. This process will continue through the first 3 quarters of 2022 with the goal of finalizing all phases of development by the 4th quarter. In October 2021, the NCUA released the Automated Cybersecurity Evaluation Toolbox, also known as ACET, which provides credit unions the capability to conduct a maturity assessment aligned with the Federal Financial Institutions Examination Council's cybersecurity assessment tool. Using the assessment within the toolbox allows institutions of all sizes to determine and measure their cybersecurity preparedness. The use of the toolbox, however, is entirely voluntary and does not introduce any new requirements or expectations on credit unions. Next slide, please. Payment systems is a new supervisory focus for the NCUA. In 2022, NCUA examiners will review payment programs during credit union examinations. The scope and depth of the review will be based on the risks presented by the payment programs offered to the credit union membership. When assessing payment systems risks, examiners will consider the comprehensive risks associated with all payment programs. This means looking beyond common payment system services such as ACH and wires to also consider programs such as remote deposit capture, ATMs and plastic card programs, including debit, Visa, or MasterCard programs, and mobile payments. For example, if a credit union both originates and receives ACH transactions, it may be considered higher risk than a credit union only receiving ACH transactions. If a credit union offers remote deposit capture, its transactional risk could be higher than a credit union not offering remote deposit capture. In these examples, the examiner should tailor reviews based upon the risk factors present. NCUA examiners will also focus on credit union payment systems programs, on the effectiveness of operational, transactional, physical, and logical risk mitigating controls. NCUA examiner reviews should focus on risk identification and measurement by reviewing items such as board-approved policies and procedures and management oversight. In addition, NCUA examiners should review corresponding mitigating controls such as internal controls on audits, business continuity programs and testing, and vendor management, which includes vendor due diligence and onboarding new payment-related products and services. Next slide, please. The Bank Secrecy Act, also known as BSA, has been a continuous supervisory focus for the NCUA since 2015. The Anti-Money Laundering, or AML Act of 2020, and the Corporate Transparency Act amended the BSA for the first time since 2001. FinCEN and the federal banking agencies, including NCUA, are currently in the process of implementing the various aspects and requirements of the Act. As a result, credit unions should expect that there will be new requirements as part of implementing these acts. The NCUA will communicate changes in BSA and AML requirements to credit unions and examiners as needed throughout 2022 and beyond. Next slide, please. Capital adequacy will continue to be a supervisory priority in 2022. both the implementation of the final risk-based capital rule and the impact of the COVID-19 pandemic on a credit union's capital position necessitates a closer review of capital adequacy. Our examination staff will be mindful of the impact of share growth on credit unions' net worth positions and the overall impact of the COVID-19 pandemic and relief efforts' effects on credit unions' capital positions and financial stability. Additionally, the risk-based capital rule, effective January 1st, 2022, requires complex credit unions, those with total assets greater than $500 million, to hold capital commensurate to their risk. The implementation of this rule required significant revisions to the call report. NCUA exam staff will review the accuracy of the call reports filed by complex credit unions, being mindful of the new data elements required by the risk-based capital schedules. Some complex credit unions may qualify for the complex credit union leverage ratio capital framework and can opt into this framework. By opting into the complex credit union leverage ratio, these credit unions will not be required to report on risk-based capital. The NCUA will be providing additional training for both exam staff and the industry on the changes to the capital framework in both February and March of this year. In addition to the call report changes related to the risk-based capital rule, the NCUA improved the overall organization of the call report and reduced the quantity of data fields on the call report by as much as 18% to reduce the burden of reporting on credit unions, and also revised the call report instructions accordingly. Next slide, please. For loan loss reserving, credit unions are required to implement FASB's current expected credit loss methodology, also known as CECL, by January 1st, 2023. Examiners will discuss with credit union management how implementation efforts are going, including any challenges they might have, and if they'll be ready by the effective date of January 1st, 2023. We will continue seeking simplified methods to assist smaller or less complex credit unions, as well as emphasize that we don't expect perfection in modeling on day one. CECL methodology will continue to evolve even after the implementation date. For credit unions not yet adopting CECL, they will continue to follow FASB's incurred loss methodology as found in ASC subtopic 450-20 on loss contingencies and ASC 310-10 on loan impairments. Generally, credit unions with less than $10 million in total assets are not required to follow generally accepted accounting principles and therefore CECL, unless expressly required by an appropriate state supervisory authority. Instead, these credit unions will be required to have a reasonable reserve methodology, provided that it adequately covers known and probable loan losses. NCUA examiners will evaluate the adequacy of the credit union's allowance for loans and lease losses accounts by reviewing the allowance for loan and lease loss policies and procedures, such as documentation of reserving methodology, including modeling assumptions and qualitative factor adjustments, adherence to generally accepted accounting principles, and independent reviews of credit union reserving methodology and documentation practices by the supervisory committee or by an internal or external auditor. Next slide, please. And now I will turn it over to Office of Consumer Financial Protection Director Matt Bellores to discuss the Consumer Financial Protection Supervisory Priorities for 2022.
Thank you, Nagi, and good morning, Chairman Harper, Vice Chairman Hoffman, and Board Member Hood. This is Matt Bellores, Director of the Office of Consumer Financial Protection, and I'd like to highlight this year's Consumer Financial Protection-related supervisory priorities. The COVID-19 pandemic continues to affect consumers and could result in increased consumer compliance risk in certain areas. Therefore, NCUA's 2022 consumer compliance activities will continue to emphasize some of the regulatory changes enacted since the start of the pandemic. In addition, this year examiners will focus on the Service Member Civil Relief Act, fair lending, and overdraft payment programs. Let me quickly touch on each of these. As in 2021, consumer compliance scope steps this year will include reviews of forbearance and other accommodations credit unions have provided to their members during the pandemic. The reviews will focus on mortgage loans and non-mortgage loans, with the category of mortgage loans being divided into subsets of CARES Act loans and other non-mortgage loans. The objective of these reviews will be to assess a credit union's compliance management system and ascertain whether credit unions are effectively managing the loan accommodation process. This assessment will also include reviewing whether credit unions are offering borrowers available forbearance options fairly and consistently, properly handling documents submitted by borrowers experiencing a COVID-19 related financial hardship, properly servicing loans in forbearance, and not misleading borrowers about any aspect of forbearance or of accommodation. Additionally, this year, examiners will review a credit union's procedures and controls for reporting loan accommodations to the credit reporting agencies and confirm that the credit union is designated loans in accordance with CARES Act amendments to the Fair Credit Reporting Act. I should point out examiners will only review this particular issue in credit unions that were not reviewed for the CARES Act Fair Credit Reporting Act amendments in 2021. Regarding servicing, examiners will evaluate a credit union's policies and procedures regarding implementing the 2021 COVID-19 mortgage servicing rule, which temporarily amends certain servicing requirements under Regulation X to assist borrowers affected by COVID-19. Examiners will also review how credit unions are handling the Service Member Civil Relief Act foreclosure protections, as well as evaluating credit unions' SCRA consumer complaint response. Regarding fair lending, examiners will identify fair lending policies and practices that may indicate overt discrimination risk or loan portfolio underwriting discrimination risk. In addition, examiners will assess whether a credit union has policies and procedures to evaluate the consistency and accuracy of appraisals and determine whether a credit union has a reconsideration of value process for the appraisals it obtains. And lastly, examiners will request information about a credit union's policies and procedures governing any overdraft payment programs, monitoring audit of its overdraft programs, and communications it provides to consumers about such programs. This documentation will be used to facilitate OCFC's off-site overdraft reviews this year and help inform perhaps a more in-depth agency-wide overdraft review in 2023. This concludes my portion of the presentation. I appreciate your time this morning, and I'll turn things back over to E&I Director Kelly Lake.
Thank you, Matt. Participation lending and corresponding risk management practices will remain a regulatory focus. In 2022, NCUA examiners will assess the quality of participation lending risk management practices at credit unions, including how changes to participation lending in response to the pandemic has changed the risk profile of credit unions and credit unions' assessment of third-party relationships. Key risk management practices include risk assessment and planning, effective due diligence of third parties, and risk measurement, monitoring, and control practices. Additionally, NCUA examiners will review how credit unions implemented changes, if any, in response to the temporary regulatory relief of the NCUA participation lending regulation, which was granted at the start of the pandemic and has been further extended through December 31st, 2022. Specifically, the regulatory relief increased the aggregate amount of loan participations that may be purchased from any one originating lender from the greater of $5 million or 100% of net worth to the greater of $5 million or 200% of net worth. Next slide, please. The off-site posture of many credit unions over the preceding 2 years has increased the potential for fraud risks in many different areas, including insider fraud, payments fraud, cyber-enabled fraud, and others. In 2022, the NCUA will continue to perform transaction testing and reviews of internal controls and separation of duties while off-site to the extent practicable, and we hope to include additional enhancements later this year. Next slide, please. On March 5th, 2021, the United Kingdom Financial Conduct Authority and ICE Benchmark Administration announced that the 1-week and 2-month U.S. dollar LIBOR settings will cease to be published immediately after December 31st, 2021. The overnight and 1, 3, 6, and 12-month U.S. dollar LIBOR settings will be extended through June 2023, which will provide additional time to wind down or renegotiate existing contracts that reference these LIBOR settings. Given LIBOR's discontinuance, entering into new contracts, including derivatives, that use LIBOR as a reference rate after December 31st, 2021, would create safety and soundness risks, including litigation, operational, and consumer protection risks. For this purpose, a new contract that includes an agreement that 1, creates additional LIBOR exposure for a credit union, or 2, extends the term of an existing LIBOR contract. A draw on an existing agreement that is legally enforceable, for example, a committed credit facility, would not be viewed as a new contract. As such, I would like to make reference to the chairman's letter to credit unions from October of 2021, which included an interagency statement on LIBOR transition. Credit unions are encouraged to cease using low LIBOR index in any new transactions beginning in 2022. Credit unions should also ensure that all existing contracts have robust fallback language that includes a clearly defined alternative reference rate. During 2022, INSWE examiners will focus on credit unions with significant LIBOR exposure or inadequate fallback language. In May 2021, the INSWE issued Letter to Credit Unions 21-CU-03 LIBOR transition that also included Supervisory Letter 21-01 evaluating LIBOR transition plans. The supervisory letter provides the supervision framework examiners will continue to use to evaluate a credit union's risk management processes and planning regarding the transition from LIBOR. Next slide, please. Interest rate risk is also a supervisory priority for the NCUA in 2022, given the high share growth credit unions have experienced over the last 2 years. Considering the surplus funds, a potential rotation into longer duration assets could potentially result in much higher interest rate risk. Conversely, investing a significant amount of assets into short duration alternatives at low rates could depress earnings. A slight increase in the duration of assets at a credit union with a lower equity ratio may result in a lower interest rate risk supervisory risk rating. Credit unions should continue to carefully model and manage interest rate risk using a broad range of scenarios that include multiple prepayment speeds and yield curve assumptions. Next slide, please. In 2021, the INSWE deployed the Modern Examination and Risk Identification Tool, also known as MERIT, and associated systems, including INSWE Connect and the Data Exchange application. The INSWE conducted over 370 internal and external training sessions for INSWE examiners, regional and central office staff, and the SSA exam and office staff on the end-to-end examination process and new applications. Additionally, the INSWE hosted a webinar for credit unions in September 2021, highlighting the functionality of the new tools available, of which an archive is available on INSWE's website. MERIT replaced ARIES and is the INSWE's new examination system to manage the examination process. MERIT provides emerging technology, integrated workflows, and improved transparency with a single application to document examination results. The flexible application will allow the examination program to change and evolve with changes in regulations, exam focus, and technology. MERIT also provides for an improved examination process with state regulators. The NCUA and state examiners can work together and collaborate on areas of review, but MERIT has flexibility to still allow for unique processes for each state. MERIT also provides for integration of data for robust financial and loan and share analytics using a business intelligence tool. The analytic capabilities within MERIT will strengthen risk identification, allowing examiners to focus on credit unions and asset portfolios that pose the most risk to the industry and the Share Insurance Fund. MERIT will also provide the channel for secure interaction with credit unions during examinations. Credit unions can submit examination documents directly through MERIT and provide updates on examination findings. In addition to MERIT, INSWE Connect provides role-based access to authorized users to securely access INSWE applications from a single dashboard. As more applications are added to INSWE Connect, users will realize the benefits of more immediate access to applications. User management functions are delegated to designated credit union and SSA administrators and provides operational efficiency by alleviating the need for INSWE resources to add users, reset passwords, and other functions for thousands of users. Authorized credit union users can access various applications through INSWE Connect and participate in the exam process by uploading loan and share files through the Data Exchange application, also known as DEXA, and using MERIT to respond to document request surveys, view and respond to exam concerns, and download completed exam reports. Next slide, please. As noted in the NCUA's Examiner's Guide, credit unions may record their meetings, which includes exit conferences and joint conferences between credit union officials and NCUA examiners. Credit union officials should ask for the examiner's concurrence before recording the meeting, a request to which the examiner should normally agree. Any rare cases of disagreement will be addressed at the regional management level. Credit unions should refer to local, state, and federal laws and consult with legal counsel prior to recording conversations, especially as it relates to any requirements to obtain consent from the parties involved. Also consistent with the examiner's guide, the examiner has the discretion to request that a copy of the recording or a transcript be sent to the examiner. It is important to note that this guidance only applies to official meetings between credit unions and NCUA examiners and does not extend to state supervisory authority examiners or meetings between credit unions and the state. We advise credit unions to consult with legal counsel and the SSAs, state supervisory authorities directly for those matters. Next slide, please. With regard to the NCUA CAMELS rating system, in October 2021, the NCUA board finalized a rule that added the S component for market sensitivity to the existing CAMEL rating system and redefined the L component, thus updating the CAMEL rating system to CAMELS. Adopting CAMELS allows the NCUA, state supervisory authorities, and federally insured credit unions to achieve greater transparency in the ratings and clearly distinguish between liquidity risk in the L component and sensitivity to market risk captured in the S component. The final rule is effective for examinations beginning on or after April 1st, 2022. The evaluation of the S component includes an assessment to determine the effectiveness of management's interest rate risk program. An effective program includes comprehensive interest rate risk policies, appropriate and identifiable risk limits, clearly defined risk mitigation strategies, and a suitable governance framework. The S component also reflects the credit union's exposure to changes in its earnings and capital position arising from changes in market prices and interest rates. The L component evaluation includes assessing the credit union's current and prospective sources and uses of liquidity. Examiners will also consider a credit union's size, complexity, and risk profile when determining the adequacy of management's liquidity risk management program. Adopting the CAMELS rating system does not change examiners' review steps to evaluate a credit union's interest rate or liquidity risk positions. Except for the examination report separately disclosing the liquidity risk in the L component and sensitivity to market risk in the S component, credit unions and examiners will not experience changes in examination procedures. The NCUA will host several webinars over the next few months for examiners and the credit union industry to go over the implementation of the S component to the CAMELS rating system. Next slide, please. We appreciate the collaborative efforts across the NCUA to develop the Supervisory Priorities Letter and look forward to continuing those collaborative relationships in future endeavors. That concludes our prepared remarks. We welcome any questions you may have.
Thank you so much, Kelly, Nagi, and Matt, for your informative briefing on the priorities for the NCUA's examination program in 2022. As you noted, these priorities were issued to credit unions and examiners earlier this month in a letter to credit unions. During the last year, I have frequently noted that the agency's top priority is to ensure that the credit union system and the National Credit Union Share Insurance Fund can adapt to the evolving nature of the COVID-19 pandemic and its financial and economic disruptions. The NCUA supervisory priorities for 2022 reflect that need by focusing on the areas of the greatest risk to credit unions, members, and the broader financial system. With supply chain disruptions, labor shortages, inflation, the Omicron variant, and stresses on household finances, our examiners will focus on critical areas like capital, liquidity, and a credit union's ability to manage credit and interest rate risks. Our examiners will also look at a credit union's loan loss reserving practices to ensure that they are correctly accounting for potential losses commensurate with their risk and internal policies. Additionally, in 2015, the 2015 risk-based capital rule and the recently adopted complex credit union leverage ratio became effective at the start of this year for those credit unions with more than $500 $500 million in assets. These rules will help to ensure the continued stability of the credit union system as it navigates the next phase of the pandemic and in the years ahead. As these rules are implemented, NCUA examiners will be mindful of the effects of recent share growth on credit unions' net worth and risk-based capital ratios. They will also ensure that a credit union evaluates the impact of its COVID response and relief efforts on the capital position and financial stability. Our supervisory priorities also include areas like fraud, payment systems, and cybersecurity. Additionally, ensuring continued compliance with the Bank Secrecy Act and anti-money laundering laws and regulations remains a priority so as to prevent our financial system from being used by criminals and terrorists. Moreover, the emergence of new technologies and changes in how financial institutions operate and offer financial services because of the pandemic have only increased the potential for risk in these areas. This is especially true for cybersecurity. The pandemic has increased cybersecurity exposures for all parts of the financial services sector, including federally insured credit unions. I cannot stress this point enough. All credit unions, regardless of size, are vulnerable to potential cyber attacks. As a result, we must remain laser focused on these issues. The NCUA is committed to strengthening the readiness of the credit union system to respond to these risks through our supervisory program and with tools like the ASET Toolbox, training, and the Community Development Revolving Loan Funds Grants and Loan Program. However, all of us, the NCUA, state supervisors, vendors, and credit unions are responsible for protecting our systems, improving our ability to recover from incidents, educating our staff, sharing information, and reporting and addressing potential vulnerabilities. Several critical consumer financial protection matters are also included in this year's priorities, as Matt noted in his discussion earlier. In 2022, examiners will focus on the areas related to the pandemic, fair lending, the Service Member Civil Relief Act, the Fair Credit Reporting Act, and credit union overdraft programs. These supervisory efforts will ensure that all members have access to safe, fair, and affordable financial services and products. As such, examiners will identify fair lending policies and practices that indicate discrimination or loan portfolio and underwriting discrimination risk. NCUA examiners will also assess whether a credit union has the proper policies and procedures to evaluate the consistency, fairness, and accuracy of appraisals it obtains. In supervising overdraft programs, examiners will request information about credit union overdraft policies and procedures, as well as monitoring tools and audits of credit union overdraft programs. Credit union communications with members about these overdraft programs will also be reviewed. In my view, the overdraft practices of some credit unions are fundamentally detrimental to members and inconsistent with the definition of a federal credit union in the Federal Credit Union Act. We anticipate using the documentation gathered this year for a more thorough review of credit unions' overdraft programs in 2023. Finally, given the ongoing uncertainty associated with the pandemic, the NCUA will continue to conduct much of its examination and supervision activities remotely, at least until it is safe to return on-site. This off-site posture will help protect the health and safety of the NCUA's employees and contractors, as well as those who work at credit unions. The NCUA continues to closely monitor the pandemic's trends and will resume on-site examination and supervision work when safe to do so. However, the NCUA is still prepared and able to step on-site when necessary, such as when we identify instances of fraud. Before I recognize my fellow board members, I have several questions for the panel. First, Kelly, it has been 2 years or longer since most credit unions have had an NCUA examiner on site. How important is it to review a credit union's internal controls more closely when we are able to return to work on site?
This is Kelly, and thank you for the question, Chairman. Because internal controls are key to fraud mitigation, it really is imperative that credit unions implement, monitor, and enforce these during our off-site posture. Internal controls are an important part of our small credit union examination program, and we will continue to use transaction testing to test these controls as much as possible during our off-site posture, and especially once we're able to return to on-site work. That concludes my response.
Kelly, I very much appreciate that answer. At a recent discussion with my fellow regulators, including state regulators, the point was made to us that when we get back on site, it's really we're going to need to look at internal controls. We haven't been there, and I do appreciate that we are going to be looking there. Another concern that I frequently hear from credit unions is about the implementation of the FASB's current expected credit loss rule, as Nagi pointed out, also known as CECL, which is scheduled to begin for fiscal years on or after December 15, 2022. What educational materials are planned to help credit unions with CECL's implementation?
Thank you for the question, Chairman Harper. This is Nagi. I'll take this question. So presently, there are many educational resources on our public-facing webpage titled CECL Resources. The page has links to relevant documents, including the 2020 issuance of the Interagency Policy Statement on allowance for credit losses. And we plan to perform targeted examiner training in the second half of this year. If there are any specific training needs on certain elements of CECL, credit unions should feel free to email E&I Mail, which is eimail@ncua.gov. I repeat that, eimail@ncua.gov, with questions, and we will develop just-in-time materials. The NCUA is committed to supporting the industry across the finish line of implementation of CECL. And on that note, we will not expect perfection or a gold standard on day one, as we previously mentioned during the briefing. The CECL estimate involves a high degree of management judgment is inherently imprecise. So examiners will not criticize the estimate provided the judgment is fully supported. This concludes my response. Back to you, Chairman Harper.
Nagi, I appreciate that. I know that on the bank side, the Federal Reserve has developed a simplified method for smaller institutions to comply with CECL. What are our plans for developing a simplified CECL spreadsheet here at the NCUA for credit unions to use?
Thank you for the question, Chairman Harper. We do have a prototype based on the weighted average remaining maturity simplified method that uses call report data, which FASB has issued a question and answers document on its acceptability back in 2019. The method is almost ready to demonstrate to NCUA senior management. And upon we receive approval from NCUA management, we will share it with FASB to ensure it is acceptable. And then once FASB approves, we will disseminate to the industry. We are targeting having this ready for the industry to use by March 31st of this year, provided that we obtain the timely approval from FASB on the method that meets this target timeline. This concludes my response. Back to you, Chairman Harper.
Thank you, Nagi. So really this spreadsheet, and by using this spreadsheet once adopted, credit unions will be able to avoid having to spend thousands upon thousands of dollars on contractors. I know that there have been some vendors out there that have been marketing themselves at $5,000, even $10,000, even $20,000 a month. This spreadsheet will help to avoid those costs, correct?
Correct.
Great. Thank you, Nagi. Matt, my last two questions are for you. In recent years, the NCUA has annually conducted between 25 and 30 fair lending exams, and we have budgeted resources to increase the number of fair lending exams this year. What issues has OCFP identified during exams in past years related to fair lending?
Yes, Chairman Harper, this is Matt Valores, Director of OCFP. Our fair lending analysts, they did confirm illegal discrimination in 2 2021 fair lending examinations. In both instances, credit unions included minimum age variables in their automated underwriting system. Our team continues to work with these 2 credit unions on suitable restitution and remediation plans. I should also point out last year, we also finalized restitution and remediation plans in 4 credit unions based on 2020 fair lending examinations. These plans resulted in remediation for approximately 64,000 affected members, plus credit unions' commitments to fund new first-time home buyer and first-time auto buyer lending programs. We also required 12 credit unions to correct and resubmit their HMDA loan application registers because error rates we found exceeded interagency resubmission standards. Analysts also noted some level of compliance management system weaknesses in most credit unions that they examined. That concludes my answer, Chairman Harper.
Matt, thanks for that. Also, too, Matt, how is your office evolving its fair lending program to include more than just HMDA data when assessing where to perform fair lending exams?
Sure. So HMDA data remains a very vital important because it includes demographic information about applicants that in some instances is not otherwise available. So as you alluded to, Chairman Harper, we don't rely exclusively on it in our fair lending examination selection process. We use software to overlay census data with HMDA data to generate information that is not available exclusively with HMDA. Likewise, in selecting credit unions for a fair lending exam or supervision contact, regional recommendations are critical to this process, given their direct knowledge of credit union lending practices, policies, and credit union management teams. They are in a unique position to identify fair lending risks that we want to factor into our schedule. NCUA violation and complaint data are also considered. And I should close and say that field of membership is also an important factor in considering, especially if we're looking at some potential redlining. We've got to be mindful of field of membership as it relates to credit unions on that process too. That concludes my answer. Back to you, Chairman Harper.
Thank you, Matt, for your helpful responses. Before closing, I urge all credit unions to continue working with their members experiencing financial difficulties. To support your efforts, the NCUA has instructed its examiners to refrain from criticizing a credit union's efforts to provide prudent relief for members when conducted in a reasonable manner with proper controls and management oversight. As credit unions navigate the next phase of the pandemic, such efforts will help ensure that credit union members, local businesses, and community are able to recover and prosper. That concludes my remarks. Vice Chairman Hoffman, you're now recognized.
Thank you, Mr. Chairman, and thank you, Kelly, Nagy, and Matt, for the presentation. I appreciate the opportunity to ask questions about our supervisory priorities at a public board meeting, as it supports transparency and I hope improves clarity. One of the reasons I took this job was to address the issue of communication between the regulator and the regulated. You've heard me say before that we as regulators do not always realize the impact of our words on the credit unions. I'm grateful to see the section in the letter on recording of official meetings for federally chartered credit unions. This is something NCUA has allowed for years, provided that the agency gets a copy of the recording. But until the pandemic created this forced experiment on working remotely, we didn't have an easy and non-awkward way to normalize recordings. Now we do. Recording meetings benefits the credit union, the examiner, and the agency. It provides a record of exactly what was said, maybe not what was meant, but there is no argument about what words were used. It also provides a historical record of past exams, which should be very useful to new board members, new credit union executives, and to examiners. It's also never been easier to record exams given programs like Zoom and Teams. Recording is already common practice at many government agencies as well as in the private sector, and I'm sure it will prove to be a godsend in many situations. Speaking of clear communication, I'd like to comment on a couple other topics that are new to the supervisory priorities: participation loans and call report changes. On participation loans, credit unions must utilize safe and sound practices as they manage their loan portfolios. This seems self-evident, but over the last year I've heard from several credit unions who've expressed frustrations over our, NCUA's, lack of clarity on due diligence and confusing definitions for reporting. I'm concerned that because we haven't been crystal clear about the details of our expectations and definitions, some credit unions have chosen not to utilize this helpful option. Now that participation loans and eligible obligations are part of our supervisory process, we owe clarity to the credit unions and to examiners. The supervisory letters section on capital adequacy and risk-based capital requirements reference call report changes. First, I want to thank Mary Jo Thor, Vicki Bragg, Angela Betts, and Paul Mackey for the work they did on the modernized call report. I think the revised call report is a flat-out better product, and it should pay dividends in the future. Change isn't always easy, even when change is for the better. Depending on which credit unions you talk to, some feel these changes are too much too fast, and others believe they'll manage them well. Either way, we must be flexible and understanding, as some credit unions struggle through the new reporting form. I encourage credit unions to watch NCUA's February 10th webinar on the revised call report. That concludes my remarks. A couple questions here. One is, do we have a plan to address the lack of clarity around participation loans and eligible obligations?
This is Kelly, and I will take that question. Vice Chairman Hoffman, we are looking at this issue from both a reporting and regulatory perspective. From a reporting perspective, we understand where clarity might be needed, as eligible obligations are not currently distinguished in the call report instructions. And then from a regulatory perspective, we are currently in discussions with our Office of General Counsel to explore regulatory adjustments and options to provide additional clarity on the matter, which we will then bring forward for the board's consideration. That concludes my response, and back to you, Vice Chairman Hopman.
All right. Thank you for that answer. And when we say we'll be flexible with credit unions, and maybe they may have trouble filling out the new call report, what does that mean? Specifically, does flexibility mean an informal discussion where the credit union agrees to fix it? Is that a finding? Is that a DOR?
This is Kelly again, and I'll also take that question. So we understand that credit unions may be apprehensive about correctly completing the call report given the significant changes starting with the March cycle. And as a result, we do have an industry webinar planned to walk through the changes, including the form layout, components, relocated items, and additions. We also have several edits built into the software that can assist with completing the call report accurately. And also information is included in the CU Online banner that is instructing credit unions on who to contact for help. I also wanted to note that if NCUA finds the call report to be inaccurate, we do allow corrections to be made after the initial call report is submitted without penalty. Regarding your question about a finding or document resolution item, it really does depend. So if a call report correction is due to the changes and a misunderstanding of the instructions, an examiner would not cite that as a document of resolution item, but likely include it in the report as an examiner finding, so there is a record of what needs to be corrected. However, and this is where the depends part comes in, if the call report contains an error that materially misstates the financial statements, that could rise to the level of a document of resolution item. And we'll just be sure to include that in our examiner training so there's a clear understanding of our flexibility in this regard. That concludes my response, and back to you, Vice Chairman Hopman.
Thoughtful answer. That concludes my questions. Back to Chairman Harper.
Thank you so much, Vice Chairman, Mr. Vice Chairman. Board Member Hood, the floor is yours.
Thank you, Mr. Chairman. And I also want to thank you, Kelly and Nagy and Matt, for your presentation this morning. Kelly, I think it's the first time that you are speaking to the board in your new role as the Director of the Office of Examination and Insurance. So welcome and congratulations on your new appointment. As we look at our supervisory priorities, you're welcome, of course. You know, as we look at our supervisory priorities for the year, I believe it's worth noting that some things change from year to year in our priorities letter. But I want to point out that as we look at the Bank Secrecy Act, which I don't need to tell you all how critically important it is, I note, though, that there are some substantial changes to BSA for the first time since 2001. Can someone please speak to those changes?
Thank you for the question, Mr. Hood. I'll take that question. This is Nagy. So the NCUA, FinCEN, and the remaining federal banking agencies are currently working together, and we are in the process of implementing the various changes to the BSA requirements. Credit unions in general should expect new or revised requirements for their risk-based BSA, AML, and countering terrorism financing policies and procedures and processes. But as those new or revised requirements are implemented by the NCUA, FinCEN, and the remaining interagency partners, and to remain transparent with the industry, we will communicate to credit unions that all the changes to the BSA requirements and any impact on the examination process incrementally throughout 2022 and beyond. This concludes my response. Back to you, Mr. Hood.
Great. Thank you for such a very detailed response, Nagy. Matt, this is a question for you regarding fair lending. And that is, I understand from many of the credit unions that a lot of the issues that we often detect, they tend to stem from faulty default settings from some of our third-party vendors. Will we be reaching out to the third-party vendors to apprise them of this situation?
Hi, Mr. Hood. This is Matt. Yes, I think that's something we will plan to do. I know that we touch on this issue when we participate in interagency fair lending webinars, when we've conducted our own outreach. And really, I would encourage credit unions to look at this particular aspect of it under their kind of proper due diligence, external vendors, to make sure there's a clear understanding of what those default settings are set at, and there's a clear documented sign-off by officials of where they would move those and tweak those to best suit their needs. I liken it back to the old adage that you can delegate a task, but you can't delegate responsibility. So in the end, if a consumer is harmed, we do look back to the credit union for making sure that there were controls put in place to prevent that or remediate it if it does take place. But that is something we'll certainly put on our agenda this year to do some more outreach on.
Great, thank you. I really appreciate it. And regarding CECL, I have to tell you, I really still think that CECL should not be a part of our credit union environment. When it was implemented, it was, in my opinion, a solution in search of a problem. While I recognize its role, I still don't think it's something that credit unions should be a part of. And many of you may recall when I was testifying before Congress and even meeting with FASB, I was pretty vociferous in saying that let's not have credit unions be subjected to it. But be that as it may, it is now something we must contend with, and I'm delighted to know that we are going to be providing training and guidance to the credit unions as they adopt this model beginning in 2023 with the phase-in over 3 years for the loan loss reserves. Could someone please just speak to the training just again so our stakeholders joining us today can know that we are going to give them guidance?
Mr. Hood, this is Nagy. I will take that again. So regarding CECL, yes, we will be providing training throughout 2022 on multiple interims. Regarding CECL, we have the information included on our website, the CECL Resources website, which contains links to multiple different documents in regards to the interagency policy statement on the allowance for credit losses. And then in addition to that, any additional training or information that credit unions might feel they need can be emailed to us at enimail@ncua.gov, and we will develop just-in-time materials for credit unions. As we mentioned before, we are committed to supporting the industry through the finish line, and if the industry feels there is a need for additional or any specific related training needs, they can reach out to us, and we will definitely work with them on it. That concludes my response. Back to you, Chairman. Back to Mr. Hood.
Yeah, great. Thank you. And again, I just want the industry to know we are going to work with you in this regard. Yes, I understand that some of our other regulators are looking at simplified processes and forms and spreadsheets just this way. So I was delighted to hear the chairman make reference to those. I also understand that there may be some other fintech groups that are looking to help address this issue as well regarding a simplification. But do know, industry, that we are not just going to say, go out and be successful. We are going to give you the tools and training efforts that you need to comply and to do it successfully. I do have another question, and this was something I know we've already heard from Gira Bozeman earlier today regarding the civil monetary penalties and credit unions. I know some of those fines, you all, come as a result of call reports, filing, and submissions. Given the fact that we are going to be migrating to the new call reports, is there any way that we can have flexibility in terms of those penalties being assessed through folks getting to work out the kinks and wrinkles of migrating to a new call report?
This is Kelly, and I'll take that question. So the NCUA has not enforced any civil money penalties related to call report submissions since the onset of the pandemic. So I believe that there is some flexibility there regarding civil money penalties and call reports with the new changes. That concludes my response.
Great. Thank you, Kelly. And you all, I will just conclude my remarks now. And Mr. Chairman, I just believe that going forward, we're going to have to better account for changes that the fintech industry is having on the cooperative business model. For example, fewer and fewer members are applying for loans at a credit union branch. More and more loans are being acquired by credit unions through loan participations, largely through the coordination with the fintechs. I do believe that these data fields should be updated and refined in our modernized call reports. In the months ahead, I will be working with our fellow board members, and I will be calling on the agency to consider a comprehensive fintech rule so credit unions can best compete in today's dynamic marketplace, while also making sure that NCUA understands how rapidly the business model is shifting right before our very eyes. And again, it's going to be important to do this so that we have the necessary data to keep the system safe and sound, and also to protect the integrity of the National Credit Union Share Insurance Fund. I have no further questions or comments, Mr. Chairman. Thank you.
Thank you so much, Board Member Hood, and I certainly agree with you that we live in an evolving system, and we need to continually develop our rules in order to keep pace with that. Before closing out this agenda item, the board would like to thank the many people involved in developing the supervisory priorities letter. There's an old adage that many hands make for light work, and that was certainly true here. In the Office of Examination and Insurance, individuals included Tim Sagerson, Lisa Roberson, Vicki Narwhal, Nagi Khaled, Shelvia Sims, Tom Fay, Allison Clark, Andrew Bludorn, Cindy Johnson, Janelle Porter, David Blanchard, Ernie Chambers, and Travis Vaughn. Also contributing to the letter were Yvonne Aploni from the Office of National Examinations and Supervision, Robert Parrish from the Office of Business Innovation, Matt Baloris and Ernestine Ward from the Office of Consumer Financial Protection, and Amanda Parkhill from the Office of the Executive Director. Kelly Lay, also thank you to you and your predecessor, Myra Tepe. To everyone who's been involved in this effort, you've done a really good job. Thank you. The fourth and final item on our agenda today is a board briefing on how the expiration of the CARES Act and the Consolidated Appropriations Acts impact the Central Liquidity Facility. Staff presenting is Anthony Capetta, Vice President of the Central Liquidity Facility, and I might add soon to be President starting next week. Staff available for questions also includes Justin Anderson, Senior Staff Attorney, Office of General Counsel. Anthony, you may begin when you are ready.
Thank you, and good morning, Chairman Harper, Vice Chairman Hopman, and Board Member Hood. This is Anthony Capetta, the Vice President of the Central Liquidity Facility. In response to uncertainty brought about by the beginning of the global pandemic on March 2020, Congress enacted the Coronavirus Aid, Relief, and Economic Security, or CARES Act, that made several temporary but substantial changes to Title III of the Federal Credit Union Act, which governs the Central Liquidity Facility. The changes to Title III were to sunset on December 31st, 2020, but the Consolidated Appropriations Act of 2021 extended them until December 31st, 2021. Additionally, on April 13th, 2020, the NCUA Board approved an interim final rule to make enhancements to the NCUA's Central Liquidity Facility Rule, Part 725, to cohere the regulation with the statutory changes in the CARES Act. This was later followed by, on January 14th, 2021, a decision to do the same for the Consolidated Appropriations Act. Today's briefing will provide information to stakeholders on the impact of the expiration of these changes, as well as present NCUA's efforts towards CLF improvement. Next slide, please. The Central Liquidity Facility, CLF, or facility, was created by the National Credit Union Central Liquidity Facility Act. The facility is a mixed ownership government corporation which exists within the NCUA, and the CLF office manages the facility under the oversight of the NCUA Board. The purpose of the CLF is to improve the general financial stability by providing member credit unions with a source of loans to meet their liquidity needs and thereby encourage savings, support consumer and mortgage lending, and provide basic financial resources to all segments of the economy. The CLF was created by Congress in 1979 because credit unions needed their own source of funds to meet their liquidity needs in the same way that the Federal Reserve System's discount window provided access to loans for banks. Access to the federal contingent liquidity sources has changed favorably over time. For example, credit unions who qualify may now borrow from the Federal Reserve discount window. But the CLF continues to be an important major backup source of liquidity for both federal and state chartered credit unions. Because the CLF is authorized to make loans to the National Credit Union Share Insurance Fund, the CLF also provides this Share Insurance Fund a vital source of funds to assist with any system-wide liquidity events that may occur. Next slide, please. In recent years, up through the fourth quarter of 2019, CLF membership had grown to 275 regular members. And at the beginning of the global pandemic in March 2020, was at 279 members. A credit union becomes a regular member of the facility by submitting an application and subscribing to capital stock of the facility. With the enhancement of the CARES Act, both natural person credit unions and corporate credit unions could become CLF members. With any NCUA's encouragement and support, regular membership then increased from 279 to 347 regular members, and all 11 corporate credit unions chose to support the credit union system by becoming agent members and providing capital for all their members with less than $250 million in assets. This asset threshold was wisely chosen as Part 741 of NCUA's rules, known as the liquidity rule, requires federally insured credit unions with less than $250 million in total assets to establish access to at least one federal liquidity source. This rapid and substantive commitment to securing an on-demand emergency liquidity source for their members quickly increased CLF membership through the corporate agents from 0 in March 2020 to an average of 3,760 over the next 8 quarters. Currently, there are 347 credit union regular members and 3,648 credit unions who have access to the agent memberships, equating to 80% of all natural person credit unions that now have access to liquidity through CLF advances. Next slide, please. Excuse me. The CLF has 2 primary sources of funds which it can use to fund advances to its members, and limitations exist on the amount of funds available from each source. To balance these limitations on funding sources against its need to expeditiously respond to urgent and high priority requests, the CLF generally maintains a minimum balance in its operating account while funding each new request for funds, first with advances from the Federal Financing Bank. When acting on the behalf of the CLF, the board has the power to borrow from any source, provided that the total face value of these obligations does not exceed a multiple of the subscribed capital stock and surplus of the facility. Before the CARES Act, this multiple was 12 times, and the borrowing authority in the first quarter of 2020, as shown on the chart, was approximately $7.5 billion. After the passage of the CARES Act, this multiplier was temporarily increased to 16 times, and together with the growth in membership discussed on the previous slide, borrowing authority increased considerably to approximately $36 billion. With the sunset of the CARES Act at the end of the fourth quarter of 2021, the CLF borrowing capacity contracted by approximately 1/3 and returned to a basis where $1 of paid-in capital translates to $24 of borrowing capacity versus $32 under the CARES Act. However, as 10 of the 11 corporates have not withdrawn their capital provided on behalf of their membership and thus maintained access to liquidity from the CLF for their membership, the CLF's borrowing authority remains at a robust $26 billion. Next slide, please. With the expiration of the CLF provisions in the CARES and Consolidated Appropriations Acts, temporary changes made to the Federal Credit Union Act returned to their original language. These changes include a decrease in the CLF's maximum legal borrowing authority, the revocation of the NCUA Board's authority to approve agent membership groups that cover a subset of natural person credit unions instead of all their members. The definition of liquidity needs in the Act again references those credit unions primarily serving natural persons, and the reverting to the original language for loan authority that says, quote, the board shall not approve an application for credit, the intent of which is to expand credit union portfolios, close quote. Next slide, please. Additionally, on April 13, 2020, the NCUA board approved an interim final rule to make enhancements to the liquidity rule, to the CLF rule, Part 725, and cohere the regulation with the statutory changes in the CARES Act. With the expiration of the CLF provisions in the CARES and Consolidated Appropriation Acts, 2 of these regulatory enhancements sunset, while 2 remain permanent. The 6-month waiting period for a new member to receive a loan is permanently eliminated. The notice period for membership termination and stock redemption reverts to the original timeframes that were in effect on March 1st, 2020, and that is 6 months for members whose stock represents, 5% or less of the outstanding CLF stock, and 24 months for those members whose stock represents more than 5% of the outstanding stock. The regulatory provisions related to corporate credit unions purchasing capital stock are removed, and the easing of collateral requirements for certain assets securing loans is permanently changed from a net book value of at least 110% of the loan to a net book value at least equal to amount as required by the CLF's collateral margin table, which is published on the NCUA website. Next slide, please. So how do these changes impact the current future CLF members? For the 3,648 natural person credit unions that are currently provided access to the CLF through their corporate's agent membership group, they still have access to the CLF advances until the end of this calendar year. If, however, their corporates end its agent membership, the natural person credit union can maintain access to the CLF by becoming a regular member of the facility and can request an advance as soon as new member documents are completed and the required capital stock amount is remitted. Instructions on how to apply for regular membership and accompanying digital forms can be found on the NCUA website, the CLF page. Also on the website is a membership capital requirement estimator that can assist potential members in estimating the amount of paid-in capital required based on the most recently available validated call report data consistent with the statutory timeframes required. To generate a subscribed capital stock estimate, a user simply enters its credit union charter number as instructed at the top of the page. Membership is affordable and easy, and now collateral requirements for larger advances for liquidity needs due to short-term adjustments, seasonal credits, or protracted adjustment credits by requiring slimmer margins for many of the collateral types normally found on a credit union's balance sheet. However, the narrow loan authority in the Act is reinstated. Next slide, please. For the corporate credit unions, as of December 31st, 2021, they are no longer permitted to borrow from the CLF for their own needs. Furthermore, any corporate that became an agent member under the CARES Act provision permitting an agent to purchase stock for only a subset of its membership must, by December 31st, 2022, either purchase CLF stock for all its member credit unions or terminate its membership in the CLF. Recognizing this may be cost prohibitive if the corporates want to terminate their participation as agents in the CLF, they may, like any member of the CLF, request the CLF return their paid-in capital stock, and the notice period is waived until December 31st, 2022. I will note that the CLF has invested subscribed capital stock in both overnight and short-term floating rate treasury securities, and together with maturing long-term instruments has sufficient funds to meet anticipated redemptions. Next slide, please. Credit unions, agents, and regular members of the CLF should know that the NCUA board have been and continue to be vocal advocates for enhancing the CLF through policy and action. On November 29, 2021, the NCUA board respectfully requested that Congress make permanent enhancements to the CLF contained in the CARES Act in a letter signed by all three members. Quoting from the letter, these enhancements provide the NCUA with a vital tool to ensure continued liquidity of the credit union system as it responds to the COVID-19 pandemic and beyond. And again, quoting from the letter, permanence would provide regulatory certainty for federally insured credit unions and bolster the credit union system's ability to respond to any future emergencies by serving as an essential shock absorber for the credit unions and the National Credit Union Share Insurance Fund. The full letter is available on the NCUA's website. Next slide, please. Going forward, the NCUA and the CLF are prepared to meet the demands of membership in the event of loan requests to support the liquidity needs of its members as governed by the Federal Credit Union Act and the NCUA rules and regulations. During this year, as we continue to advocate for permanent reform, the CLF will ensure a smooth transition and support changes in membership as needed. Participation in the CLF remains voluntary. Indeed, we recognize that participation is a business decision for each credit union and its board. Our hope, nonetheless, is that eligible credit unions will consider becoming regular members of the CLF. Growing the facility's membership enhances its ability to borrow increasingly greater amounts of funds, thereby providing more liquidity to the credit union system. By significantly increasing access to external funding, the facility can better fulfill its central purpose and improve general financial stability by meeting the liquidity needs of credit unions. That concludes my briefing, and now we'd be happy to answer any questions you may have. Back to you, Chairman.
Thank you so much, Anthony, for your informative briefing on the status of the Central Liquidity Facility, or CLF for short, following the expiration of its enhanced statutory authority at the end of 2021. Before I begin my remarks, I do want to formally congratulate you, Anthony, on your selection as CLF president. I am confident that the facility will be well managed under your steady hand and that with your vision, the CLF will achieve its full potential. With currently more than $26 billion in borrowing capacity, I am pleased to see that the CLF remains a strong source of emergency liquidity should the need arise in 2022. However, the expiration of the enhanced borrowing authority and other CLF provisions in the Coronavirus Aid, Relief, and Economic Security Act, or CARES Act, is concerning, especially with the pandemic and its financial and economic disruptions continuing into this year. That's why my fellow board members and I continue to call on Congress to make permanent the legislative enhancements contained in the CARES Act. I thank Vice Chairman Hauptman and Board Member Hood for their efforts in support of this critical legislative endeavor. And we will continue our efforts to make these changes permanent if possible and support interim measures like a temporary reinstatement of this authority if available. Restoring these enhancements would ensure that there is a strong liquidity backstop for the credit union system should the need arise in the future. Restoration would also provide regulatory certainty for federally insured credit unions and bolster the credit union's ability to respond to future emergencies, with the CLF serving as an essential shock absorber for the system and the National Credit Union Share Insurance Fund. In times of economic prosperity, the U.S. financial system often has ample liquidity for an availability for those that need it. However, as we have seen during times of economic and financial stress, like the 2008 crisis, that liquidity can quickly dry up, leading to significant risks for credit unions and the broader financial system, if not addressed. That is why the financial system has federal liquidity backstops built in, like the Federal Reserve's discount window and the NCUA's central liquidity facility, to provide essential liquidity to maintain stability and confidence during economic downturns and periods of financial stress. While credit unions overall have so far weathered the pandemic well, and the system continues to have ample levels of liquidity, primarily because of a large inflow of fiscal support during the last 2 years, all of us must recognize that much economic uncertainty remains as we start 2022. The rapid spread of Omicron and the continued supply chain disruptions are affecting consumer pocketbooks, labor markets, and businesses. What is more, for the first time in more than 40 years, Americans must deal with inflation. Higher inflation has led the Federal Reserve's Federal Open Market Committee to announce that it will remove monetary policy accommodation much more aggressively, with many economic forecasters expecting these measures to begin as early as March. These economic challenges will place additional stress on household finances and financial markets, and that stress could have negative implications for credit union performance in the months ahead. We also know from painful experience that we can expect credit unions' liquidity to increase any time that there is an economic contraction. Like firefighters responding to a blaze, the NCUA needs to be ready to provide that emergency liquidity quickly before the lack of liquidity spreads and undermines the strength and stability of the credit union system. The return to a pre-CARES Act structure for the CLF will impede the NCUA's ability to respond to effectively to future shocks. Before closing, Anthony, I have 2 questions for you. First, why was the enhanced authority for the CLF under the CARES Act so important for the credit union system? And does the CLF have a role in supporting the credit union system during periods of relatively good financial economic performance?
Thank you, Chairman Harper. 2 great questions. The enhanced authority for the CLF provided under the CARES Act was important to the credit union system for several reasons. The COVID-19 pandemic created uncertainty for credit unions and their members. Liquidity, like capital, is a pillar of strength upon which the safety and soundness of the credit union system rests. The enhanced authority allowed for and encouraged greater industry participation and membership in the CLF. The greater access to emergency liquidity to help assure credit union operations could remain uninterrupted during the rapidly evolving crisis. Furthermore, the enhanced authority provided an, if needed, additional liquidity source for the Share Insurance Fund, further instilling confidence in the credit union system. The CLF does have a role in supporting the credit union system during relatively good financial and economic performance as well. CLF membership not only provides a form of liquidity insurance for individual credit unions and the broader credit union system, but CLF members may borrow for their own liquidity needs and they earn a quarterly dividend on their capital stock. Even if credit unions have contingent liquidity sources in place to address both planned and unplanned liquidity needs, credit unions may still benefit from the CLF's lending terms compared to other market and federal funding sources. That concludes my answer. Back to you, Chairman.
Thank you, Anthony. Lastly, what external factors justify having this enhanced authority for the CLF and the potential for liquidity needs over the long term?
This is Anthony again, and yes, no one knows if the impact of the global pandemic on the economy has been fully realized, nor can they predict when the next severe economic downturn will occur from some exogenous event like the collapse of the housing market that led to the Great Recession in 2007, 8, and 9. The CLF plays an important role in addressing potential credit union system liquidity risks from events like those. The permanence of the enhanced authority would provide regulatory certainty for federally insured credit unions and bolster the credit union system's ability to respond to any future emergencies by allowing the CLF to serve as an essential liquidity source for the credit unions and the Share Insurance Fund over the long term. That concludes my answer. Back to you, Chairman.
Thank you. Again, I want to assure all stakeholders that restoring and making permanent the enhanced authorities provided to the Central Liquidity Facility as part of the CARES Act remains front and center for the NCUA. My fellow board members and I are committed to working with Congress on this vital legislative priority. That concludes my remarks. Vice Chairman Hauptman, you are up.
Thank you, Mr. Chairman, and thank you, Anthony, for the update. Congratulations on being selected as the CLF president. Back in March, I noted that credit unions were awash in liquidity. They still are today. But we all know things can change quickly. We also know that another financial crisis isn't an if, it's a when. When the next financial crisis occurs, the CLF needs to be ready. Some of its readiness will depend on Congress, and we will work hard to convince them of that. Other parts of the CLF's readiness will depend on the things that we, as the CLF board, and you, Anthony, as CLF president, can do. Corporate and credit union participation plays a direct role in the CLF's ability to borrow. Credit unions supply the capital upon which the CLF's borrowing capacity is determined. Greater participation means greater borrowing capacity, which we've seen can be critical in a major liquidity event. I look forward to learning more about your plans for increasing participation of credit unions of all sizes in the CLF. And when a credit union has a liquidity crisis, time is of the essence. Time, or lack of time, is what makes liquidity issues a crisis. As we know, many credit unions participate in the CLF through their corporates. This saves money and saves time up front, and we're grateful to the corporate system for playing such an important role. It also makes it important that documentation or agreements are up to date. Up-to-date documentation by all parties could save days of waiting in a crisis. Conducting test loans to confirm systems, the corporates, the credit unions, and our systems, are ready could also save precious time. Right now, we have the precious gift of time, something we will not have in a crisis. The CLF can be an even more powerful tool for the protection of the credit union movement, but we must act now. Thank you, Mr. Chairman. That concludes my remarks. I have no questions.
Thank you so much, Mr. Vice Chairman. Board Member Hood, the floor is yours.
Thank you, Mr. Chairman. And thank you for your presentation this morning, Anthony. And I join my colleagues in congratulating you on your recent selection as the president of the CLF. I support extending the CARES Act provisions related to the Central Liquidity Facility and have joined the chairman and vice chairman in calling for its extension. I must say I was quite pleased that we took the unprecedented action as a board to all three offices come together to write and sign a joint letter to Congress asking for its extension. We almost recognize that by the time you realize you have a liquidity problem, it may be too late to act. But I recognize the decision to extend the CARES Act provisions is ultimately left up to the members of Congress. In general, however, I do not view the CLF's issues as just a legislative problem. I think one of the problems is that it hasn't made a significant loan since the financial crisis over a decade or so ago, which was, again, as you know, was about 12 years to be exact. We as an agency need to work, I think, much more cooperatively with the industry on behalf of the CLF. And that, Anthony, is why your position was created. In the past, the CLF president's duties was one of many other duties here at the agency. So your position today was created as a standalone one so that you can and we can be much more collaborative and transparent with our industry. When the CLF was created in the 1970s, credit unions were completely outside of the Federal Reserve clearing system. There was no credit union access to a lender, shall we say, of last resort at that time. The corporate system also wasn't yet created, but the world has changed significantly since the creation of the CLF. While the CLF may need to be a lender of last resort, especially during times of crisis, I believe we also need to revamp the system. We need to sit down with our corporate credit unions and natural person credit unions to create a cooperative facility that reflects the realities of today's dynamic marketplace. Mr. Chairman, in that regard, I would appreciate working with you all to require that the NCUA board be briefed on the status of the CLF at least once a year so that we can publicly be briefed on its progress. Now, Anthony, I do have a few questions for you. How much did the CLF earn in its investments in 2021? And what did we pay by way of a dividend?
Thank you for your question, Board Member Hood. 2021 investments earned just over $4.5 million, and the CLF paid out dividends of just over $1.6 million. The dividend rate was consistent with what the Federal Reserve pays on reserve balances. And for quarter one through quarter four, 2021, that rate was 0.15%. The remaining funds were used to pay operating expenses, about $940,000, and to build retained earnings. Since 2009, it has been the investment policy of the CLF to maintain a reserve of retained earnings to support the risks to the facility, and to the extent that that function is satisfied, to further be able to support the cost of operations through the management of income generated by the investment of retained earnings. The ratio of returned earnings to capital stock for all members is approximately 3.6%. That concludes my answer. Back to you, sir.
Great, thank you. And Anthony, in the days to come, I do hope that we can look at opportunities where we can pay out more than just a fraction of the net income. But thank you for the reasons that you've just articulated. But again, that would be a nice aspirational goal to, again, pay out a little bit more than the fraction than what we paid to date. Again, I was very delighted to support you in becoming president of the CLF. A lot of that stemmed from the time that we had during the interviewing process. And I wanted to know, what ideas do you have for improving the CLF with its owners and stakeholders? I know that you're just getting word of your selection and that you'll be officially taking the new role next week, but would love to maybe hear one or two ideas that you shared during the interview process.
Thank you, Board Member Hood, for this important question. As we look forward to improving the CLF, as we've discussed here today, I recognize that to deliver on our mission and our value proposition to the owners, the system, and to grow the CLF membership, we need to do more. Initially, some of my ideas include, as you also mentioned, improving direct communication and engagement with the stakeholders. This may be accomplished through greater participation in industry forums, more one-on-one meetings with the owners, creating and participating in working groups, and leveraging organizations like the Corporate Credit Union Alliance to not only message what the NCUA and the CLF is doing, but more broadly solicit ideas and, where possible, assistance on what we can do better and to make the CLF an invaluable tool to assist credit union liquidity planning and asset liability management. NCUA's efforts with Congress to improve the CLF, making permanent changes to Title III of the Federal Credit Union Act, are strengthened by the industry support and our efforts to improve the CLF together with its owners. I look forward to working with the board to help accomplish this. That concludes my answer. Back to you, Board Member Hood.
Great. Thank you, Anthony. And we, too, as board members, all look forward to working with you as well, and delighted to hear about the stakeholder engagement that you're going to be pursuing. And I would just add, in addition to working with the natural person credit unions and the corporates, since you are going to be looking at all things relating to liquidity, let's not forget having outreach sessions with the Federal Home Loan Banks, since they also provide a source of liquidity to our institutions, and also the Federal Reserve and those regional banks and the access that our large entities have through their discount window. So add them to the list as your schedule allows. And with that, I have no further questions or comments, Mr. Chairman. Thank you.
Board Member Hood, thank you so much. I would be very remiss if I didn't recognize your leadership in getting the CLF enhancements enacted when the pandemic first started. They were truly, they were an important backstop for us to have. And I also share your vision of a more robust CLF system. I think that that's only good for credit unions overall. I also very much like your idea with respect to having at least one annual briefing a year. We may want to have more from time to time, but at least one a year on CLF so that we can continue to update everyone, but also remind people to join the CLF overall. And I'll work with you on figuring out what the best timing is for that, whether that be January, June, or some other month overall. Thank you to everyone for participating in today's proceedings. That is the end of our agenda today. There being no further business, we are hereby adjourned.